Okay, so welcome to tonight's class. So this is class 2 of the 4 Accelerator Bootcamp for FAC4862, FAC4864. So tonight the first few minutes we're gonna spend on working through how to set up a statement of changes in equity and what gets included in the statement of change in equity. What does the statement of change in equity tell us, and then also how to get certain numbers. Okay, so that's what we're going to spend most of the time on, and then we're going to start actually answering the question. So why I want to spend some time on that, it is because this is only one question on statement of change in equity. But if you have an overview of how to get the numbers, then no matter what they present to you, you'd be able to handle. So I don't just want to answer the statement of change in equity relative to this question. I want to answer it in general, and then we're going to go into it for this particular question. And that's what you want to do. So, for example, like I made mention of yesterday when we read through the scenario, is that they gave us 3 inventory intercompany transactions as well as an intercompany sale of equipment. So for each of those, right? So when you look at inventory intercompany sale, you want to have a look at it from parent to sub to parent. So in this case, I think it was parent to sub. So, but then afterwards, you want to ask yourself, what would the impact be if it was sub to parent? So now using the one question, you are learning both possibilities. Similarly, in another part of the question they gave us where it was an associate inventory sale between associate and parent. So I think it was associate to parent. So then afterwards, once you're done with the question and after you mark, when you ask yourself, what if this was parent to associate? What would the impact be? And when I talk about the impact, is basically when you ask yourself, what would the impact be on the balance sheet? What would the impact be on the income statement? And what would the impact be from a journal entry point of view? Okay, so how the journal entries look if it was the other way. Okay, so that is the stuff you want to be able to do. So there's no need to run through another question to that deals with that. You handle it right there and then. So that is how you start to learn the entire syllabus by doing a few questions and not all the questions available. So that's very important that you want to handle that, right? So although this question, when it comes to the intercompany, it's more specific relative to how it's going to impact the statement of changes in equity. And the way it's going to impact the statement of changes in equity is through the profit or loss calculation, okay? But despite that, when you're dealing with these questions, first answer it what the question is asking of you. And then, like I might mention, when you go through the process of marking and all of those type of stuff, now you go a little bit more detail on the what ifs. So for example, like I just made mention with the intercompany sales, it went from one way, from parent to sub. So then you ask yourself, what if it was sub to parent? But then you want to ask yourself, what is the impact on how the journal entries look? What would the impact be on balance sheet? What would the impact be on income statement? So like in this question, they're only asking, we only need it for the statement of changes in equity through the profit or loss calculation. But try, once you're done with the question, to ask yourself, for those intercompany transactions, how would the journal entries look and what would the impact be on the balance sheet? We know what the impact is on the income statement because we're going to need it for the statement of changes in equity, but we're not asking ourselves what is the impact on the balance sheet. So that's what I mean. Don't limit your thinking to the actual question. First, answer it based on the question, but then afterwards you ask those other questions. So that is why when you do this, as opposed to running through questions, because when you just run through 100 of questions, All you are training your brain to do is answer whatever they're asking you. You're not training your brain to actively ask other questions, to think a bit differently. And that is what, when you do the thorough review after you have done the actual question, you are training your brain to be more of an active thinker and to ask yourself, what if this, what if that? And that helps you with critical thinking and helps you with problem solving and all of those type of stuff. Okay, and that is the skills that you need for the real world. So when you like when you do a balance sheet question, don't just answer the balance sheet question. Take a moment to ask yourself, what are we trying to achieve with the balance sheet? How does the balance sheet actually look? And the answer you should be able to give you is that every single line for assets and liabilities is going to be 100% of the parent, 100% of the subsidiary, plus group adjustments. There is no associate, there is no joint venture. There can be, or there will be, a joint operation if there is a joint operation. But basically, the balance sheet is going to look, for assets and liabilities, 100% of parent, 100% of subsidiary, plus group adjustments. Remember, the group adjustments are twofold. What are the two group adjustments? Either intercompany transactions or transactions relating to fair value adjustments at acquisition. Okay, so those are your type of group adjustments. Then for an associate, how do you bring the associate onto your balance sheet? Through one line item called investment in associate. Or if it's a joint venture, one line item called investment in joint venture. Remember, for a joint operation, it is similar to a subsidiary where you bring on every single line item. But for a subsidiary, you bring on 100%, whereas for an associate, for a joint operation, you only bring on your percentage. So you will bring on PPE, you'll bring on inventory, you'll bring on debtors, but you're not going to bring on 100%, you only bring on your percentage. Generally, let's say 50%. Okay, so just be aware of that. So you want that picture in your head before you even go and answer the actual question, so that when you are doing, you know what you need to be looking for. You're not guessing. You actually know that when you're doing PPE, the number that must be in PPE must be 100% of parent, 100% of subsidiary, our percentage of a joint operation, plus group adjustments. So you know that, and then there is no need to be guessing. So if they give you a scenario where the accountant included the PPE of a joint venture or the PPE of an associate, you must already know that is not right, because a joint venture and an associate, you do not bring on the line items of the assets and liabilities, because you only bring it through as one line item, investment in associate. Okay, so those are the type of stuff you want to be thinking, because they can ask you anything. So if you are able to already see those pictures in your mind, then no matter what they give you, you'll be able to handle it. So that is how you're going to be able to handle it. If you answer the question without any numbers. If you can't answer the question without numbers, then you're not 100% there yet. I'm not saying you must have no numbers, but like I mentioned when I said PP, I can tell you PP is going to be 100% of parent, 100% of subsidiary, our percentage of joint operation, and group adjustments. So when I'm looking for numbers, that is the stuff I'm looking for to include. So that is what you want to be able to do. And that's what we're going to do now with the statement of changes in equity. What would the statement of changes in equity look like without looking at numbers? So we must be able to say, this is going to be like that, this is going to go there, this is what the number should be, or how you'd get to the number without having specific numbers. That is the level you want to get to. That's how you will be able to pick up if there are any errors, and that's how you'll be able to navigate a scenario when it seems complex. Okay, so that is what I want to get to, and that's why I'm going to spend a bit of time on how to prepare a statement of changes in equity. So let's get into it. Okay, so let's deal with this. So when you prepare a statement of changes in equity, so they'll ask you to prepare. When you have to prepare, remember the three things you need to do. You need to put in the company name. So it is Mumbai Ltd. Okay, so it's Mumbai Ltd. Let's see, could be something. Okay, so Mumbai Ltd Group. Okay, so there's the company name. That's number one. The second thing is the name of the statement. So remember, it will be statement of changes in equity for the year ended. Okay, so remember, when it comes to the statement of changes in equity, when it comes to the statement of changes in equity, it is for the year ended or for the period ended, whereas when it is, so for every statement, it is for the year ended. But when it comes to the balance sheet, statement of financial position, it is as at. So that's very important. Don't lose marks if you get, they will penalize you for getting these terminology wrong. So every statement is for the year or for the period ended. For our purposes, it's generally a year. So for the year ended, the balance sheet is as at. So that's what you're going to do. And the period ended, I can't remember what's the period ended, 31 August 2018. Okay, so you will put the year over there. I just put it over here just to show the three elements. 31 August 2018. You will put the year there next to year ended. Now remember, we're busy with groups, so it's not just statement of. It is not just statement of changes in equity. It is consolidated statement of changes in equity. So I didn't want to put in the word consolidated first. I first wanted to show you this statement, but then I'm telling you, then I'm bringing it to your attention that we're busy with groups. So therefore, we need to put in the term consolidated. Okay, so that is your 1 mark or your half mark. So now we're going to deal with the statement of changes in equity. Okay, so the whole idea over here is to reconcile the opening balance, which is 1 September 2017. There is no need to put in the date. I'm just putting the date for our purposes, to the closing balance. 31 August 2018. So remember, the whole purpose of a statement of changes in equity is to reconcile the opening balance to the closing balance. So when you look on the balance sheet, you will see prior year, current year. But that doesn't, so that tells you what was a prior balance, that tells you what was a current year balance, but it doesn't tell you what caused the movement. And that is what the statement of changes in equity is telling the users of financial statements. It is explaining to them how did the opening balance move from the opening balance to the closing balance. Okay, so just be aware that is what we're trying to achieve. So the columns is going to be whatever would appear on the statement of financial position. So your typical columns would be as follows: share capital. I'm going to put in all that is possible, although you're not going to be required to do all in every question. So share capital, retained earnings, revaluation surplus. Remember, what is revaluation surplus? Revaluation surplus is the revaluation gain or loss on land. So we'll generally take it to revaluation surplus. Then we would have marked to market. So mark-to-market reserve. Once again, what is this? This is the fair value gain or loss on financial instruments that is classified through OCI. Okay, so just be aware of that. Then, so retained earnings represents profit or loss. Okay, so remember your income statement has two parts. It has a profit or loss section and it has other comprehensive income section. So the profit or loss section gets closed off to retained earnings. All of these are OCI. So what generally happens, companies separate the different types of OCI. So OCI as a result of revaluation on land goes to revaluation surplus. OCI as a result of fair value gains or losses on financial instruments that goes through OCI gets taken to mark-to-market reserve. Okay, so that's what they basically do. Then we would have change in ownership. Okay, so change in ownership, that is when there is a change in ownership, and it's only for a particular type of change in ownership. So it's a change in ownership where a sub before the change in ownership and after the change in ownership, you are still a subsidiary. Whether you went from small to big sub or big to small sub, the fact of the matter is, if there was a change in ownership transaction, and before and after the change after the transaction, you are still a subsidiary, then the gain or loss will go into in the column called change in ownership. So remember, the reason why the gain or loss comes in directly into the statement of changes in equity, it is because it is a transaction with the owners. It is a transaction between parent and NCI. They are both owners. So because it is a transaction with the owners, the gain or loss cannot go through profit or loss. Please be aware of that. Okay. Now, it's not a requirement to have a separate column for the gain or loss. There's no requirement to have this column, but in the real world, most companies have this column. Okay, so that is why we always do it. So for our purposes, for academic purposes, you always gonna have that column. In the real world, not always, but in most cases, you will see, if you look at financial statements, they will have this column because most companies want to be able to keep track of the various balances. Okay, and then we will also have FCTR. Okay, so we can call it FCTR. It stands for Foreign Currency Translation Reserve. Okay, so we'll have a column for this. You will only have that column if you have a foreign operation. So this is for FAC4, FAC2, you won't have it. Okay, but so you'll have it if you have a foreign operation. So most likely for FAC4, you will have these two columns because they're always going to give you a change in ownership, and 99.9% of the time you're going to have foreign operation, and 99.9% chance you're going to have change in ownership. Okay, so they will have that. I'm not saying you're going to be given statement of change in equity, but you're going to have a foreign operation and you're going to have change in ownership. Okay, so brace yourself for that. This will result in the parents total. Now, in most cases, they don't want the parents total, but I am showing it because this is how it looks in a income statement, in a statement of change in equity. Then you will have NCI, okay, and then this will give you total. So this is basically what the balance sheet would look like under equity section. Okay, so that is basically, yeah, I don't think there's anything else. Okay, so just take note. Now we must explain how did this opening balance go to the closing balance. That is what we're going to have to explain. So in most cases, they're not going to ask you for share capital because for our purposes, not in the real world, but for our purposes, there is no change in share capital. So the opening balance will always equal the closing balance. Okay, so the opening balance will always equal the closing balance. Okay, so just be aware of that. So the opening balance will always equal the closing balance. In the real world, that's not true, but for our purposes, it is true. Then we're going to have retained earnings. Okay, so the opening balance of retained earnings is one of the most challenging calculations. So I'm going to give you a separate formula for how to calculate it. Okay, same thing. If you can calculate the retained earnings, you'll be able to calculate the revaluation surplus, mark-to-market reserve. Okay, and so I'll give you a formula for retained earnings, and I'm going to give you a formula for NCI. It's not really a formula, it's just more a way of thinking and how to set up the calculation. Okay, so opening carries a lot of marks because there's lots of principles that they're going to test in these two numbers. Okay, so we'll deal with that just now. So let's talk about the movement. So there are different types of movements that can go through here. Okay, so the one movement would be total comprehensive income. Total comprehensive income. Total comprehensive income comes from the income statement. But like I just mentioned earlier, the total comprehensive income or the statement of comprehensive income is made up of two parts. It's made up of profit or loss and other comprehensive income. Other comprehensive income. Okay, so that is what we will have. What's looking for? No, they're not. Okay, anyway, maybe just do this for now. Okay, so what you must know that total comprehensive income is made up of profit or loss and other comprehensive income. So profit or loss, the parent's portion of profit or loss goes through retained earnings. So remember in the income statement, you would when you have profit or loss, or when you have total, other comprehensive income and total comprehensive income, that is 100%. Okay, so that is 100%. Then below total comprehensive income, you have two sections. You have a section called profit attributable to, and then you have parent NCI, and you have total comprehensive income attributable to parent and NCI. So remember, over under retained earnings, so everything over here must only represent the parent's portion. You must get that straight in your head. Everything over here must represent only the parent's portion, because NCI will have their portion over there. So under retained earnings, we're going to have profit or loss, but not any profit or loss. It is the profit or loss attributable to the parent. Okay, very important. NCI's profit or loss will go over here. Once, and in this, as you do this question, I'll show you a way of doing calculations. There's different ways of doing a calculation. I'll show you like a way I prefer. You choose a way that is useful for you. But the way I'm going to suggest to you tends to be quite useful in general, no matter which question you get asked. So I'll follow that approach, even though it may not be required. But just to show you that if in a very complex question, you'd want to use the approach I'm going to be using. In a less complex, you don't have to. But obviously, I'm training you for a complex situation, so that it's easy for you to navigate and do the necessary calculations. You will come to see that it's quite simple, and I'll show you how to think through it. So here we have profit or loss. So profit or loss, the parent's portion goes to retained earnings, NCI's portion goes to NCI. So this total needs to equal to the total profit or loss that is sitting in the income statement, the 100%. Then we have other comprehensive income, and here you must just be very careful. So like we said, other comprehensive income can have different line items, right? So if you have other comprehensive income relating to revaluation surplus, then the parent's portion relating to revaluation surplus must be over here. The parent's portion relating to mark-to-market reserve must be over there. And the parent's portion relating to FCTR. FCTR goes through other comprehensive income will be over here. The NCI's portion will always be over there. Okay, so NCI is fairly straightforward. Once you have the income statement numbers sorted, NCI's total will just come in over there for profit or loss, and other comprehensive income will go over there. So, but for parent, you must just be on the be aware of it, that you have more than one type of other comprehensive income. There's most likely going to be separate columns, separate equity balances. Sorry, not that one. So for this, for that, and for that, these will generally be separate equity balances. So the parent's other comprehensive income will have to be split between what relates to revaluation, what relates to mark-to-market, and what relates to FCTR. Okay, so that's very important. Once again, in the way I set up my calculation, it'll be easy to gather this information. Okay. Now, just another important aspect, what you might just be aware of so you don't make the mistake, is that in the income statement, when you do the split, you are splitting profit or loss between parent and NCI, and you are splitting total comprehensive income between parent and NCI. So yes, for profit or loss, you can simply take the split for parent and for NCI. But for other comprehensive income, you can't, because the income statement is not splitting up other comprehensive income. The income statement is splitting up total comprehensive income. So to get to other comprehensive income, you're going to have to say total comprehensive income minus profit or loss. Just try to picture the income statement and that split at the bottom. We don't split other comprehensive income, we split total comprehensive income. So you must just not take total comprehensive income to this line. You need to take other comprehensive income to this line. Okay, so just be aware of that. Okay, so that is total comprehensive income. So remember, most of the marks will lie over here because effectively you are doing the income statement. So a lot of marks is going to lie over here because you're basically doing an income statement, not presenting an income statement, but calculating it. And then you also need to do the necessary splits. So here's a lot of marks that will be probably I'm guessing probably like 20 marks out of that 60 marks is going to be for the total comprehensive income calculation. So just be aware of that. Okay, so that is total comprehensive income. Then we can have, okay, so that is that. Let me just see what's happening over here. Okay, so now the next we can have, I'm just going as it comes to my mind. Okay, so the next we can have is an acquisition of sub. So remember the terminology they use may be a little bit different, but it doesn't matter. So acquisition, because the accounting standard does not prescribe what you must call it. Okay, they make it clear. They don't prescribe what you must call it. You might just call it something that it's something that people can understand. So acquisition of subsidiary. So what does this relate to? Acquisition of a subsidiary. I'm spelling. Okay, I think that's right. Subsidiary. I think that's right. Okay, so acquisition of subsidiary. So acquisition of a subsidiary relates to a situation where the company acquires a subsidiary in the current financial year. So you will only have that line item if the company acquires a subsidiary in the current financial year. Then it will only impact NCI. And the amount that goes over here by NCI, the amount that goes there by NCI would be NCI at acquisition. Okay, very important to take note. So just take note of that. Okay, so acquisition of subsidiary So you will have an acquisition of a subsidiary when you acquire a sub in the current financial year. If you acquire sub in a prior financial year, you won't have the line item acquisition of a subsidiary. So when you do acquire a sub in the current financial year, the line item that it will impact is only NCI. And that amount over there is the amount that is the amount of NCI at acquisition. So in your goodwill calculation, you will have it at acquisition amount. For NCI, it will be plugged in over there. Okay, so you want to be able to picture. So when you sleep tonight, you must be able to picture the statement of changes in equity and the various numbers that it will, where the numbers go, and more or less how to calculate the number. So once you have this big picture view, now you go and focus on how do I get each specific number. Okay. Next, we can have increase or decrease. In our case, we have a decrease, increase or decrease in subsidiary. Let's call it interest. Okay, so this over here, this increase or decrease in interest or subsidiary, this relates to a change in ownership type question where you went before and after you are still a subsidiary. So an increase means you went from a smaller sub to a bigger sub. A decrease means you went from a bigger sub to a smaller sub. But both before and after the ownership transaction, you are still a subsidiary. Like in this case, we have that. So we went from, I don't know, we sold a few shares, so there was a decrease in our interest, but before and after we were still a subsidiary, so we will have that over here. And remember, when there's a change in ownership question, that before and after you are still a subsidiary, it will impact change in ownership, and it will impact NCI. Okay, so why NCI? I'm not putting in brackets and so forth because sometimes the numbers can be either way. Okay, so over here, why we would have that is because NCI will, if we are going decreasing, then NCI must be increasing. If we are increasing our interest, NCI must be decreasing. This amount over here would be the gain or loss that we are making. Okay, but I'll get to the calculations and the details of that as we do the question. Okay, so that is that. Then we can have a transfer. Okay, so a transfer can happen for anything, right? So a transfer simply, for example, you have land. Okay, so you had other comprehensive income and I disposed of the land, and then you decide that, and your policy is when you dispose of land, any amount included in a revaluation must be taken out of revaluation and taken to retained earnings. That's one type of transfer. So you might just be aware of that. Okay, the same thing can happen for mark-to-market reserve. You can take it out and transfer it to retained earnings. But the one that will most likely happen is a transfer between FCTR and NCI. Okay, so, and I'm just going to put in over, I'm going to put in here also Y and Y. Okay, so the Y's is where you disposed of land, so you take it out of land and you're now transferring it to retained earnings as a policy choice. And a typical one would be over here. So you have this change in ownership transaction over here. So let's say the change in ownership transaction is as a result of a foreign operation. So this FCTR represents the parent's portion. So now the FCTR you included over there represents your initial interest of 80%. Now you have a change in ownership and you decreased your interest to 60%. So now FCTR needs to represent only 60% because you only have 60%. So what happens? You take out 20% and you transfer it to NCI. Or the other way around, if you increase your percentage, if this represents 80%, but you're now 90%, then you need to take FCTR away from NCI and transfer it to you. Okay, so that is what the transfer is all about. So we'll deal with the details. I get the big picture. Okay, I'm just trying to see what else did I miss. Okay, profit or loss, other comprehensive income, acquisition of a sub, increase, decrease, yeah, transfer. Okay. Then we would have dividends. Okay. Now dividends, you must be able to split between ordinary dividends. Ordinary dividends. So I'm splitting it, because we in this scenario we have that. Okay, just do. Okay, so we have ordinary dividends, and then we also have preference dividends. Okay, so what's important to take note, so it will be under retained earnings. So the dividends over here will only be the dividends that the parent declares. Okay, so only the dividends that the parent declares. And then over here, it will be the dividends that the sub declares, but only the NCI's portion. So this over here would be the dividends that the sub declares, but only the NCI's portion. This over here will be the dividends that the parent declares. We can also have a disposal of subsidiary, disposal of subsidiary. So when we have a disposal of a subsidiary, then also NCI will be impacted. So whatever the NCI balance is at the date of loss of control. So there's a disposal of a sub when you lose control. So so then I no longer have control. So that NCI at that date will have to be removed from the statement of changes in equity, and we'll plug it in over here. Okay, so that is basically how what can more or less come in. There may be stuff I missed over here, but off the top of my head, that is what I can think of all the type of transactions we deal with. So you want to be able to sit back and think about the various types of how the statement of changes equity is impacted. So as you can see, we're reconciling how did the opening balance go to the closing balance. It is through all of these movements. Okay, here's an important concept for you to take note, and they generally test it thoroughly without you realizing it, that this portion of the income of the statement of changes in equity only relates to that of the parent. So you must always only include the parent's component. The second aspect is that it must always be after tax. Okay, so it's always after tax, because remember, profit or loss is after tax. So profit or loss is closed off to retained earnings. Revaluation surplus. Revaluation surplus, what is closed off to revaluation surplus? It is the after-tax other comprehensive income. Mark-to-market reserve. What gets closed off to mark-to-market reserve? It is the after-tax other comprehensive income. Okay, so just take note of this over here. Then this is all it's not 100% of retained earnings. It's not 100% of other comprehensive income. It is only the parent's portion. Okay, change in ownership doesn't hit the income statement. It comes directly through into the statement of change in equity to the separate calculation. Same with FCTR. This is the parent's portion of FCTR. It is not 100% of FCTR. It is the parent's portion of FCTR, because the NCI get their allocation. Okay, so those are critical things to remember, because how they test this is they'll give you a number, and you need to get to another number. So you need to work backwards. So they're going to see whether you know that the number they're giving you is the parent's number, but you need the 100%. So are you going to take the number as is, or are you going to convert it into the 100% number? Another way they'll test it, they'll give you a revaluation surplus. Now, revaluation surplus is the parent's portion after tax. But what they're asking for you, they're not asking for revaluation surplus. They're asking you for the revaluation gain. Now, the revaluation gain is 100% before tax. So they're going to see whether you know you need to take the revaluation amount and convert it from the parent's portion to 100%. Once you get to 100%, you then need to convert it from before tax to from after tax to before tax. That's how they test the principle, to see whether you know that this amount that they are giving you is the parent's portion after tax. But what they're asking of you is to get them the income statement number. And the income statement number must be 100% before tax, because perhaps tax is shown separately. So you might just be very, very aware of that. So anything before the parents, anything that comes into this column, which is all of these, is going to be the parents' portion, and it's generally after tax. Okay, so just be aware of that. Not everything has a tax consequence, but it's typically going to be these line items over here. So, so for example, they can tell you included in profit or loss, but they typically test it over here, which is much easier. So they will give you, they will say they want a revaluation, or they'll tell you they want the fair value gain on that financial instrument, and they give you this number. So this number that I'm highlighting over here, this number that's being highlighted over there, is the parent's portion of the fair value gain after tax. But they're asking you for the fair value gain before tax. So what you're going to have to do, take the parent's portion, convert it into 100%. Now you have 100% fair value gain, but it's still after tax. You don't want the after tax amount, you want the before tax amount. So then you have to take out the tax. So they want to know, if you'll be able to know, you must do those steps. Just it is a thing that, because it's 200 more questions, I'm almost going to put my, like I can almost like guarantee it will be there, because it's a big, big principle of financial reporting. Okay, but I can't guarantee it. But I'm saying how important it is that I can virtually guarantee it. Okay, so just that is what I wanted to show you. Okay, now I'm going to show you how to calculate opening retained earnings, how to calculate opening NCI. Then I want you to go dream about it tonight. Okay, I need you to dream about it tonight, so that you have you can basically, without looking at numbers, you are able to calculate it. Okay, so you won't be able to calculate retained earnings opening balance and NCI opening balance without without what now? What do I need to say? Oh, without needing numbers. You know, in theory, how it needs to be calculated. So once you have that basis, when you read a scenario, you're not going to be guessing, and you're not going to try to remember what you did in a previous question. You have a framework of how to calculate opening balance. So that is going to make life so much easier. You're going to see, you're going to be able to just fetch numbers and calculate. The only challenging part it will be is maybe you're going to have to find the number, calculate the number, but at least it's one step easier, because if you didn't have the framework, there's two levels you need to focus on. What must be included and then how to get it. But now by me giving you the framework, you're going to know what needs to be included. And all you're going to have to do is actually go and calculate the number. Okay, so there's going to be no guessing. There's going to be a good framework. You may not get it immediately, and that's why I need you to go dream about it. Because as you dream about it, often as you work through it, it will come to a point where you're just going to know it. Okay. So let's do opening balance. Okay. And the same would apply for revaluation surplus and for mark-to-market reserve. But before I go over it, is there any questions from your side before I start it? Andile, Bernice, Ticket Singh?
No questions from my side, Faiz.
Okay.
No questions from my side as well.
No questions.
Saeed, Lebo, Rato. Okay. Check the chat. Okay. And Deepa, Mercedes. Babadime.
I don't have a question at the moment, Faiz. Thank you.
Okay. 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 So now let's work out opening balance. And this is going to work all the time, right? So you might just keep your head up straight. Obviously, it can be a little bit more complex when there's a change in ownership, but the thinking still remains the same. So once you have this framework going, then all you have to focus on is getting the number. Okay. And that in its own can be nice and challenging. And that is why this framework is so important, because then there's no guesswork. Okay. And once you have the framework, it helps you to know how you need to set out your answer and how to do the calculations. Okay, so let's have a look. So I'm going to start with NCI. So the opening balance of NCI is going to include NCI at acquisition. Okay, so your opening balance would be NCI at acquisition. But it is only, so before going to opening balance, you must understand you can only have an opening balance if you had a closing balance. So if there was no closing balance of the prior year, you can't have an opening balance. So that's important to take note. So in this question, we won't add the acquisition of the subsidiary we bought in the current year because he was not there last year. So opening balance must come from balances of the prior year. But to get to that number, because they're only going to give you the number. So to get to the number, you must take NCI at acquisition, and it will be NCI since acquisition. NCI since acquisition for retained earnings, NCI since acquisition. I'm just going to say revaluation surplus mark to market. Okay, so remember, because over here it is because over here now it can be you're not necessarily going to have both. Okay, so you might just be aware of that. So remember what is, so at acquisition is a date when you acquire, and since acquisition is from date of acquisition plus from date of acquisition up until the beginning of the current year. So that is the since acquisition period. So the since acquisition period is from the beginning of from the date of acquisition up until the beginning of the current year. If you have more than one subsidiary, you do the calculation for each subsidiary. Don't combine them. I would have subsidiary 1, subsidiary 2, total. Okay, so do the calculation for each. You will avoid mistakes. And if you get the one wrong, at least you can get full marks over here. But if you're going to combine, you can generally mix up numbers, and then it's so difficult for the examiner to see what you are doing, and they just don't want to give you any marks. Okay, and then I just want to show this separately. It's NCI, and it's only applicable for FAC4. Okay, so NCI since acquisition for FCTR. Remember, you can only have NCI if you have a subsidiary. So this only relates to subsidiaries. So if you have 3 subsidiaries, we can have subsidiary 1, subsidiary 2, subsidiary 3. You have separate calculation for each one because each subsidiary would have their own balance and they also have their own percentage. So remember, the way to go about calculating this, okay, this one is straightforward. You'll get from the goodwill calculation. But for this, because you want since acquisition retained earnings, we work out 100%. And then we split between parent and NCI. So how I do it, so you will see when we do the actual question, when I do a calculation, I work out the calculation at the 100% level. So I do it on company by company basis from a group perspective. So I look at, I can't remember what was a subsidiary over here. If I look at Fifi, for example, I'll calculate Fifi's retained earnings. I'll calculate Fifi's profit or loss at a 100% level, but from a group perspective. What do I mean from a group perspective? I will take into account group adjustments. So the way I go about doing my calculation, I start off with a number from the separate trial balance. But that separate trial balance number is not what the group wants. So what does the group want? The group wants a number that after taking into account group adjustments. So now I do my group adjustments. So once I take the number from the trial balance as is, and I adjust for group adjustments, I get to a profit or loss number, or I get to a retained earnings number from a group perspective, but representing 100%. So now that's a clean number. Now I do the split between what of that number belongs to the parent, what of that number belongs to NCI. So when I come and plug in over here, I'm basically plugging in from a previous calculation. And I do this for every profit or loss calculation. I do this for every retained earnings calculation. When I say retained earnings, I'm referring to opening and retained earnings. I do this for other comprehensive income, and I do this for the equity balance, like revaluation surplus, mark-to-market reserve. So I do it on an entity level, parent, all the subs, all the associates. And then I say, okay, what belongs to the parent, what belongs to the other parties. And then from there, that's my base of my calculations. And then I'll just come and plug in. I'm not doing any calculation over here because I'm pulling it from a calculation I've did before. And so this is useful, very, very useful for a complex question. The chance of you getting a complex question in the exam is close to 100%. So that is why I'm going to show you this approach, so that no matter what you're given, you're going to be given a scenario that have multiple companies. You can see we have parent plus 3 other companies. So there's 4 companies in here. So what solutions generally do, they work out one profit and loss calculation with all the companies in. Now, that definitely works, but that's generally useful for the lecturer setting up the answer, so you know exactly what's happening. But for you and I, that's trying to figure out, we rather focus on it company by company basis, and we do the adjustments company by company specific, and then we do the splits, and then we do a separate calculation to add them all up. So obviously the way the solution set it up is a little bit more streamlined, in a manner that by the end of that calculation, at the end of their calculation, you have the total already. The way I'm going to show you, we're going to do separate calculations for each company, and then we must still go and add it up afterwards to get the total for a group perspective. But what I can tell you is the chance of you getting 100% for that calculation is far higher than you passing the calculation for the way they said it's set up in the solution. So that's what I'll show you. What you choose is totally up to you. But this is the way I'm setting this up, is basically how I go fetch a number from a calculation I have done before. And this is basically what the opening balance for NCI would look like. NCI at acquisition plus NCI since acquisition retained earnings plus NCI since acquisition OCI. Now remember, OCI can have revaluation surplus, can have mark-to-market reserve, and then I just show the separate FCTR. Okay, because it's a different way of calculating that. So this is basically going to be your opening retained earnings. Now, all of these amounts is going to be the NCI's portion. All of these amounts is the NCI's portion from a group perspective. When I say a group perspective, I'm referring to after group adjustments have been taken into account. So this is basically how you will calculate NCI. I don't think I missed anything, so this would be NCI opening balance. Okay, I don't think I missed anything, so that would be the answer. I'm just trying to think if I missed anything. No, if I did miss anything, we'll just update it, but I don't think I missed anything. So that is basically how you'd go about calculating opening NCI. Remember, you can only have NCI for a subsidiary. Now we're going to do opening retained earnings. Now, opening retained earnings, this refers to the opening retained earnings over here, over there. Now, opening retained earnings over here is the parent's portion. Okay, so this is the parent's portion. So what is opening retained earnings going to be? So what you must know, it's going to be opening 100% parents opening retained earnings. Okay, so 100% of the parents opening retained earnings. But all of this is from a group perspective. So remember, included in the parents opening retained earnings, there could have been unrealized profits relating to intercompany sales and so forth. So you're going to have to adjust for it. Okay, so you're going to have to adjust for it. So just be aware of that. So it's 100% because remember, the parent don't share any of their own profits. That all belongs to them. So 100% of the parents opening retained earnings, but this is from a group perspective. Once again, I'm doing a separate calculation for the parents opening retained earnings. I start off with the parents opening retained earnings as per their number. And then what do? I adjust for any group adjustments, and that gives me opening retained earnings of the parent from a group perspective. Do I split anything there? I don't split anything because everything belongs to the parent. Then over here, I would have X percentage of the subsidiaries opening retained earnings. Okay. So I have X percentage of the subsidiaries opening retained earnings. Once again, and this is very important. This is actually very important. I don't want to say opening. I need to say since acquisition. Since acquisition retained earnings. So our percentage of the subsidiaries since acquisition retained earnings. Now this number and that number will come from the same calculation. Like I told you, I'm going to do a calculation for each subsidiary's opening retained earnings. So I'll start off with their figure. I'll make all the necessary adjustments that is required to get to an opening retained earnings from a group perspective that represents 100%. But then I split between what belongs to the parent and what belongs to the NCI. So if here was subsidiary 1, subsidiary 2, subsidiary 3, I would have 3 retained earning calculations for each subsidiary. So once I do the calculation, I simply go and fetch those numbers. And I'm going to show you how do we actually get each of these numbers. But basically, it's going to be what you start off with what the sub have, and you make the necessary group adjustments. Same thing with the parent. I start off with what the parent have, and then I make the necessary group adjustments. Remember, group adjustments falls into two types, or I call it into the two types. Okay, so but the two types that I refer to is basically any intercompany sales and then any transactions relating to at acquisition. Similarly, I do the exact same thing, X percentage of an associate since acquisition retained earnings. Once again, for the associate, I'm going to start off with the associate's retained earnings number. I'm going to make the necessary adjustments from a group perspective, and that will give me retained earnings from, I'm going to make the necessary group adjustments, and that's going to give me the opening retained earnings of the associate at 100% by the representing from the group perspective. Then I say, okay, 100% doesn't belong to me. I only take my portion, and the rest belongs to whoever else. So that is basically how we'll go about doing the calculation. Same thing for profit or loss. I do a profit or loss per company at 100% level. So I'll start off with profit or loss of each company that is given. Then I make the necessary group adjustments to bring profit or loss for each company at a group perspective, but that is still at 100%. Then I say, okay, what of that profit belongs to NCI? What of that profit belongs to parents? And that's basically how I go about doing the calculations. So it's so easy that if something goes wrong, it's not going to go wrong in every calculation. You can just go fix up one calculation and so forth. The only extra step that my calculation require is that you're going to have to do add up all the profits to get to the total parents portion, all the profits for NCI to get to the NCI. But that for me is minimal because the number of marks I am drawing is far more than had I do a combined calculation. Okay, so just take note of that. And then we do the same. I'm just going to go sub and associate, but remember, if it's a joint venture, if it's joint operation, but that's basically it. I'm just trying to think if there's anything I'm missing out on. No, I don't think I'm missing out on anything. So this would basically be it. This would be that would be RE opening balance. So now I use this when I read through a scenario. When I read through the scenario and I know I must do retained earnings, I already know when I know I must do retained earnings. So when I read I must do statement of changes in equity, this comes to my mind. Okay, so this comes to my mind. So automatically this picture populates in my head. Okay, so because I've trained myself how to think. So my subconscious mind knows that when I need to do statement of changes in equity, it brings this picture to mind. Okay. My subconscious mind also knows that when I must do retained earnings, I must get opening balance retained earnings. My subconscious mind know that I find opening retained earnings challenging. So it also knows that I have put in effort to make sure I don't struggle with opening retained earnings, because I know opening retained earnings counts a lot of marks. Okay, so opening retained earnings, opening NCI counts a lot of marks. And in this picture comes to my mind. So these pictures comes to my mind. So now when I'm reading, I already know that I'm going to need at acquisition. I'm going to need since acquisition for all of these stuff. but it also knows how I go about doing the calculation, that I go about doing the calculation by doing every company separately, and then splitting each company between what belongs to the parent, what belong to the other party, and then I do a next step to add them all up. Okay, for me, it does take a little bit extra time, but that extra 5 minutes I'm okay with, because I know personally for myself that that extra 5 minutes is drawing me far more marks than if I had to do a combined calculation, because I get confused. When I look at a solution from a combined calculation, I can follow. I must do it myself. It's too much for my brain to handle. So my brain handles the compartment approach, where I do company by company. So that is what I'll show you how to do it. I feel it's much more manageable. Past students have helped that way. They also prefer it. But what you must take caution, if you're not busy with a complex question, then there's no need to go that approach, because there's not going to be enough marks to justify going that long approach. But when it's a question of this nature, I think it's going to be far more better. Me personally, no matter how simple or difficult a question is, I still follow that approach because it's in me already. So I'm quite quick at it. So I don't really waste time. I would waste more time if I'm trying to do a combined calculation. My brain is not used to it. My brain is used to doing a separate calculation, so it flows. So you need to find something that works for you. But whichever works for you, it's totally okay. But all you need to know, this is what's going to be included in opening NCI. This is what's going to be included in opening retained earnings. How you get each of these numbers is all up to you. I'll just show you how I get the number, and then you can decide whether you find that useful or not. Okay. Let me just see, there's another thing I wanted to do. Yeah, so I just wanted to show you also how we're going to get that number over there, change in ownership. Okay, so how we get the change in ownership number. Change in ownership, gain or loss. Okay, so how are we going to go about doing this? So what you must understand, this change in ownership is basically a sale of an asset. Okay, now in the same way, you'd calculate a gain or loss for a sale of PPE. How do we go about calculating a gain or loss for the sale of PPE? We say for gain or loss on PPE, we do the following. We say proceeds less carrying amount equals gain or loss, equals profit or loss. Okay, so the proceeds, what you sell it for, the carrying amount of the individual asset is cost minus accumulated depreciation, and then we get a profit or a loss. Now, for this, it's also a disposal of an asset. So therefore, the way we calculate the gain or loss is the same. So the way we calculate the gain or the loss, proceeds less carrying amount equal gain or loss. Okay, so equal gain or loss. Okay, so the question, so the only difference over here is the following. The proceeds over here is whatever you sold it for, okay, or whatever you paid for it. Really, I'm talking from a sale, okay, so a decrease in ownership. The same principle, same method we use for an increase in ownership. But I'm just talking from a decrease in ownership. So when we for decrease in ownership, we're selling some of our shares, so we're getting money. So the proceeds is the money we're receiving. Same when we sell PPE, it's the proceeds represents the consideration that is being received. The carrying amount over here it is the carrying amount of an individual asset, which is PPE. So the carrying amount is costs less accumulated depreciation. Over here, the carrying amount is the shares, but the shares from a group perspective is the subsidiary. So therefore, we don't use normal IFRS 9. We use normal IFRS 9 from the separate company point of view, but we don't use IFRS 9 from a group perspective. From a group perspective, the shares we are selling represent a subsidiary. So therefore, the carrying amount must be the carrying amount of the subsidiary. And the carrying amount of the subsidiary would be what we do in terms of consolidation. So all we do with this carrying amount, we ask ourselves the question, at the date of sale, what is the equity balance of the subsidiary from a group perspective? So we ask ourselves the question, what is the equity balance at the date of sale of the subsidiary from a group perspective? So the way I do it, I get the equity balance of the subsidiary at the date of sale from a group perspective at 100%. So I get the 100% number. Then I say, okay, I'm not selling 100%. I'm only selling a percentage. Let's say 5%, 10%. So I take that 100% times it by 10 and I plug it in over here. This number over here, I'm going to remove this. This number over here, the carrying amount. The carrying amount represents the change in NCI. So whatever answer you get over here must be plugged in by NCI. Okay, which direction? Well, it depends. If you are decreasing your interest, that means NCI is increasing, so the answer must be positive. If you are increasing your interest, that means NCI must be decreasing, then NCI will be negative. Okay, so just take note of that. So basically, how do we get the carrying amount? Like I said, when we do PPE, we take the carrying amount cost minus accumulated depreciation. Over here, the carrying amount is a business. So we need to get the carrying amount of the business. So the way we do it, because the business is a subsidiary, we must apply consolidation. So we ask ourselves, what is the equity balance at the date of sale from a group perspective? From a group perspective means you must use consolidation principles. Once I get that balance, that is at 100%. I'm not selling 100%. I'm only selling 5, 10, 15%. So whatever percentage I'm selling, I take that percentage multiplied by the 100% equity, and that represents the carrying amount of the business I am disposing of. So like I said, this amount represents how much NCI is changing by. So this amount will be plugged in by the NCI number. Then, like we said, carrying amount versus proceeds. So carrying amount versus proceeds will give me a gain or a loss. This gain or loss will then go into change in ownership. Once again, it does not mean it's a gain, it is positive. It doesn't mean it's a loss, it is negative. You need to ask yourself, if you are selling, so if you sold for 100 and it's worth 90, you made a profit. So that means you'll put it in over here as a positive number. However, if you increased your interest, you paid 100 for something that is worth 90. So in effect, you paid more by 10 Rand. So therefore you made a loss of 10. So that's why it's important. Doesn't mean it's a loss. It is positive or negative. Doesn't mean it is a gain. It is positive or negative. It depends on the perspective. But basically, the change in ownership number is that gain or loss. Okay. So what I want you to do, I need you to have this frameworks in mind for tomorrow. For tomorrow, we're gonna actually now answer part of the question. So we're gonna do answering the question over today and tomorrow and Saturday, and you're gonna see how I set out my answers and how I'm gonna get to the opening balance using this format. Okay, but obviously to get to these numbers, I'll have separate calculations before. Okay, so that's all that I wanted to cover. It is a framework for statement of changes in equity and for some of the balances. The rest we're going to work through as we go along. Okay. Is there any questions from your side that you may have before we come to an end?
No questions.
Okay. Andile, Bernice.
No questions on my side.
No questions.
Okay, so you guys are fine. If there's no questions, then it's good to go. I'll see you guys tomorrow. We're going to actually go through we were going to go through answering. Just take note that you're gonna see how we're gonna bring this framework and apply it to actually answering the question. Okay. Well, guys, I'll see you guys tomorrow. Bye-bye.